96149. All right, and the discount is 100,000 minus 96149. Answer is 3851. All right. So here the coupon rate is 9%. The interest expense is based on market interest rate, 10%. So 10% semi-annually means 5% in 6 months. So how we calculate the interest expense? The interest expense is, let me change the color here. So it will be as 96149 multiplied by interest expense is going to be 96149 multiplied by 10% multiplied by 6 by 12. Answer is 4807. All right. Okay. So what we will do, because interest payment is less and interest expense is higher, so the difference between interest expense and payment, which is 4807 minus 4500, answer is 307. We will less it from discount and we will add it in the balance. Why? Because at the end, this value in 5 years will have to reach 100,000. So on every interest expense, we will deduct the difference between interest payment and interest expense, and we will add it to the value of the bond, and value of the bond increases and discount is going to decrease, right? So we'll charge the discount in our income statement. Discount is going to decrease. So how much discount left now? So 3851 minus 307. Answer is 3544. And here the value is 96149 plus 307, 96, 456. And now, what is the interest expense now? Interest expense is based on the value or book value of the bond. So this is not 96149, this is 96,456 multiplied by 10% multiplied by 6 by 12. Now answer going to be 96,456 multiplied by 6 divided by 12 multiplied by 0.1. Answer is 822. All right. And the difference between, let me change the color here. The difference between interest expense and interest payment will be less from the discount here. So which is 4822 minus 4500. Answer is 322. And you will add 322 here. All right. So when you add it, the value will become 96456. Answer going to be 96,778, where our discount is decreases to 3544 minus 322. It is 3222. All right. So this is how we create until our last step, and our last step is going to be a plug figure, because interest expense at the end the book value cannot greater than 100,000. So let's see a very nice writing and very nice amortization here. So you see interest payment 9% semi-annually, which is 9 multiplied by 6 by 12. 5% means 10 multiplied by 6 by 12. All right. So you see here, first, the discount is 3851. The value of the bond, book value or carrying value is 96149. So you see the interest expense is always greater than interest payments. And the difference is discount amortized. These are the differences between interest expense and interest payments. And all these are less from the balance of the discount. And did you notice something? That the discount is going to be decreased until it becomes here 0. So when discount is decreased, you see the carrying value is equal to the face value of the bond. All right. So how we calculated it, I have also pasted here as well. Here we go. The semi-annual payments are constant. Why? Because the company coupon rate is fixed. So this is coupon rate is always on face value. So 100,000 multiplied by 9% multiplied by 6 by 12, 4,500. So this column is the same, 4,500 for 4,500. How we find out this interest expense? Interest expense is based on market value or book value here. So 5% multiplied by 96,149. Answer is 4807. And the difference between interest payment and interest expense is called discount amortized. And that is going to be less from discount and added to the carrying value. So discount amortized is 307. And this 307 is going to be added here. And this 323 is added here. All right. So this is how we find out how we amortize the discount and increase the value till our maturity. And our maturity, did you notice that our maturity is equal to face value or our promised liability, because we promised to pay 100,000 at the end of 5 years. All right. And remember the last one here. If you multiply this 99,539 with the 5%, answer is different, because only left amount is 461. So there must be 0 here for the last payment and value must be here. So the end value must be equal to 100,000. All right, 100,000. All right. So what happened to this discount balance we talked about here? This discount balance. It decreases as it is allocated to interest expense through amortization. So 3851, which is the discount balance, total discount balance is additional interest expense over and above the interest paid. Amount of interest expense increases as bond carrying value increases towards maturity. Did you notice something here? We talked about here, the interest expense also increases and the bond value also here increases. So you see here 96,149, 96,456, 96,779, here 4807, 4823, 4839. So that's what they are saying here. This amount of interest expense increases as bond carrying value or book value or increases towards maturity. So graphically, bonds are issued at discount. So these are the interest payments. So payments are flat rate because we promise to pay 4.5%, but interest expense is gradually increases, right? And the value of the bond, you see, we issued the bond at 96,149. So gradually the bond value increases and equal to the face value of 100,000. So it means this shaded area, which is discount, discount is being decreased or amortized with the passage of time, which increases our interest expense. Guys, you understand?
Yes.
Okay. So how we are going to make the entries? Entries are the same. So Southwest journal entry to record interest expense and the interest payment for the first 6 months. So whenever there's the payment, it means this is the cash. They are promised to pay cash, and this is the expense. So what will be the entry here? Interest expense. This will go to income statement. So first 4807 interest expense. All right. And cash is 4500. Since we are decreasing the discount, so when the discount is created, we make a debit balance. But now we decrease the discount. Discount is decreased by 307. So now the entry is balanced. All right. So entry going to be interest expense to discount to cash. All right. Interest expense to discount to cash. This figure will go to income statement. This is the cash paid, and this will decrease our discount to 3544. The second entry going to be on 31st of December. Remember, the payment is on January 1st. All right. Cash is not being paid on 31st of December. So we create liability. First of all, interest expense is 48